Hello. In this theme of international economics, we dive in more detail to international money. And I start with this video lesson to briefly talk about foreign exchange markets and the exchange rates and how that influences the trade balances. So today, the foreign exchange market is really a huge, large-scale business around the world. So very briefly, there is of course a lot of there's spot markets, there is over-the-counter markets, there is forward markets. So I cannot go to a lot of details of the foreign exchange market, but I will briefly describe some of the major participants. So a very large volume of foreign exchange trade goes through commercial banks still today. So very often, for example, exporting firms or importing firms, if they have some transactions in the foreign currency, then they exchange this to their home currency through the commercial banks. And same applies, of course, to tourists or private citizens. The second major participant is multinational corporations. So, of course, multinational corporations might also trade with the commercial banks. But the reason why this is listed separately here is that sometimes, of course, by the sheer volume of this kind of payments in different currencies by multinationals, it makes that sometimes multinationals might have a major impact on the exchange rate of certain currency. The third on the list is the central banks. So the main influence of central banks is indirect by determining the domestic exchange rates. And sometimes central banks also interfere in foreign exchange markets directly by either buying or selling currency, but this is not something very typical. So it's only that tends to occur in some kind of crisis situation. So I will discuss in more detail the dependence of exchange rates on the central bank's interest rates decisions in another video. And finally, nowadays it's also other non-bank financial institutions such as mutual funds, pension funds, hedge funds, and insurance companies, for example. They can have major effects on the exchange rates, and I will talk about this in another video titled "Elephants in Equity Markets." But the main point is that of course there is a lot of foreign exchange transactions that take place continuously around the day. So there is Asian markets, European markets, the US markets. So any point of the day there is this kind of foreign exchange transactions taking place. So typically then the exchange rates between the main currencies tend to be floating exchange rates. So the exchange rate can appreciate or depreciate depending on demand and supply of the currency. So here is an example of the euro foreign exchange reference rates. So what is the rate of euro against the US dollar or Japanese yen and a number of other currencies. So in this table, the red arrow refers to the depreciation of euro, and then this kind of green upward pointing arrow refers to an appreciation of euro. So when for example euro depreciates relative to the US dollar, then it means that for Americans it is cheaper to import goods from Europe, whereas when the currency appreciates, then it is more expensive for the foreigners to import goods. So this is mainly like from from the exporter's point of view, that what this appreciation or depreciation refers to. Of course, then for tourists, if euro depreciates relative to US dollar, then for a traveler, European traveler in the USA, then finds that everything it becomes a little bit more expensive. So finally, how does then exchange rates relate to the current account balance? So I already in the previous videos I referred to this, but let's discuss this in a bit more detail still. So for this kind of trade balances and current account balance, particularly when a country's currency depreciates, then the exports become cheaper for foreigners. So most likely, then export demand, at least over a certain time period, then tends to increase. And then on the other hand, imports become more expensive for domestic residents. So this will likely then decrease import demand. So when exports increase, imports decrease. So then depreciation of a currency then tends to increase the current account balance. So this is something I referred to in this when discussed the U.S. Current account deficits. So that the U.S. dollars exchange rate then tends to automatically stabilize this kind of or if there would be some kind of problem with the deficit, then naturally the currency would simply depreciate. So then an appreciation of currency has the opposite effect. So if a currency appreciates, then exports become more expensive for foreigners. So this tends to then decrease export demand. On the other hand, appreciation of the currency makes imports less expensive. So then domestic import demand tends to increase, and then this would then decrease the current account balance. So we cannot say that either appreciation or depreciation is good or bad by itself. It just has this kind of effect on the current account balance, and of course also the current, if there is like a major current account deficit or surplus, then it can also then affect these currency exchange rates in the longer term to balance this kind of deficits. So in the next lesson, then I will briefly then discuss in more detail the most important currencies and the importance of the US dollar in the international exchange market. See you then.